Most brokers are forecasting a modest target for equity markets for the year ahead. They're citing inflation as their main concern. Early indicators in the US are suggesting that inflation is already starting to ease, and history tells us that can cause large market rallies. Gary Glover has a stronger outlook than most of the analysts, and that's for the markets to the year ahead. He's going to be walking us through the charts, the outlook, and the top trading shares this week. Good morning, Gary. How are you?
I'm great, Chris. We should be more concerned when everyone's bullish. So we should be happy that no one is. If history is any example, that's a good sign for us.
That is, there's a contrarian side of things, isn't it? Because when the market was falling and capitulating last year, we were expecting or in COVID, we were expecting 50% drops, and then suddenly the market turned and rallied and everyone was caught short or shortly invested. So are you looking at this and these indicators and kind of going, well, I'm happy to see this? Is that how you're reading these reports?
Yeah, it's great. I mean, obviously, in the bearish year, everyone was pretty bullish. Everyone had pretty bullish, so no one was sort of seeing that dip coming when growth was going crazy. And now we've had a correction. Everyone's pretty bearish. So that's just human nature. So I think it's great actually. That means that as the market starts to sort of climb here, everyone's probably underweight, so sort of forced to almost participate in the rally. And as we've seen in the past there, Chris, we highlighted it in some of those sort of 40s and 70s charts there. Once inflation started to ease, the markets really took off. I think I've phrased it, almost rip your face off type of rally is what can happen when inflation does sort of start to come off here. So we've got good signs there for the US actually having that CPI number come off quite a bit. If that continues to sort of keep heading lower, that'll be good for equity markets. I think it's great that Powell's indicator is going to keep rates high. I know the market's sort of pricing in rate cuts next year and this year, but I don't think it's going to happen sort of straight away. But that's a good thing, because in the past there in the 40s and 70s, particularly the 70s, they cut rates too quickly, and inflation came roaring back, and it was really hard to get back under control. So I don't see them making that same mistake. And Powell's made commentary around it's more important to keep rates higher than have inflation higher. So better to overdo it on rates than get overcooked on inflation. That's more important. And I agree with Powell. I think our RBA governor's got it wrong here. It's more important to get in front of inflation. It's a serious matter here. So it's great the US treating it, and I think equity markets are starting to respond to there, and we're starting to get some good outcomes. So if they can continue there, then I think you'll see signs of a bigger recovery here.
Well, the bigger recovery, that's also coming off those October lows that you did cover in great detail, and you covered that in detail from about June. So hats off to you. You really did nail that. Now, if we're looking further ahead, you're talking about Jerome Powell, you're talking about the inflation in the US, getting on top of it, how they're using it with interest rates. And you're also looking towards, in this week's report, you're talking about a February-March low. So why is it that February-March is becoming sort of that next part that's drawing your attention?
Yeah, so look, I think again, in the past, I've covered the 4-year cycle, Chris, which is that sort of, which is the midterm year low. And we spoke about it all the time as sort of like, October midterm years is, synonymous with deep lows. You just need to look every 4 years on the S&P, on most of the equities markets. And we see deep lows every 4 years, and they're around that sort of October of the midterm year. The other timing to watch there is sort of around that February-March of the following year after midterm year. So that's oftentimes you can get a new low there, but majority is sort of a higher low there, and then that's usually when markets sort of start to sort of get humming after that period. So still might do a little bit of work here, a little bit of building here. And if you look at 2002, 2003, that's a really, really good roadmap, because equities, the US market found a low in October 2002, and the Aussie market actually found a low in March 2003, because commodities actually dragged us back a little bit deeper. Again, that's sort of bonds first, stocks second, commodities third. And and that just made our index come back a little bit deeper longer term. And that's probably my biggest sort of indecision here at the moment, is that I'm not sure commodities have had their bear market yet, so that makes me a little nervous there. And if you think about inflation, if inflation is easing, and a lot of those pressures have come from high commodity prices, if the worst of inflation's done here now, that was peak inflation, and now inflation's going to ease off. It does take time here. If you look historically, it takes years for inflation to really wind back. So it's not going to be, not going to be done in 2 or 3 months. It's going to take many, many months to actually sort of cool right off. But that sort of cooling inflation historically means lower prices for commodities. So to me, that's the biggest grey area, because you're sort of seeing, like, I know we're seeing oil price cool off here and some of those oil stocks cool off, but we're seeing, iron ore is on a tear here. BHP and Rio Fortescue have been on a tear. I know they had a big down night last night, but that's the first down night for a while. But that's, normal cycle of commodities is to sort of be a bit negative towards the end of the cycle. So it'll just be interesting to sort of see what happens here. But the NASDAQ really is sort of starting to, it had 3 days last week, Chris, where it outperformed all the other indices. And I don't think that has happened in the last 12 months at all. So to me, that's a little bit of a change of character. And that's sort of showing here that maybe the inflation, signs are pretty good here. Growth can start to wade back into growth again. I still think it's going to be a little bit like 02, 03. It's going to take a little bit of time to build, but some signs there that that we've got to start looking at growth here a little bit as well. I'm still 80% on the value side, but I think I'll start to sort of venture out into a little bit more growth now.
Okay, well that's positive to see. You've got the chart here of NASDAQ that sort of looks like it's trawling out that bottom and sort of mapped out possibly a higher low coming into it. If we look at the S&P, where you're going to see more value there than you would in the NASDAQ, and we'll go to the Dow in a minute. When you're looking at the S&P side of things here, you've got kind of this congestion. Are you seeing similar thing, maybe retest the recent lows or create a higher low?
Yeah, so obviously going back to that overhead trend line, so I think everyone's sort of talking about that. There's been everyone's been showing charts of 2008, the similarities, but the last 3 or 4 weeks has sort of gone against that. But look, we're just sort of starting to see there was a pretty shallow sort of pullback, showing a bit of strength there, and we saw a bit of volume too on this rise here. So just looking positive here, man. Like I'd like to sort of see it congest back into sort of February, March. I think it'll be a bit messy here, but as I think I mentioned the last couple of weeks, most of the cycles are actually quite bullish here. The 20-year cycle is the only one that's actually a little bit negative into sort of Feb, March. Most of the other cycles, the 60-year and a lot of the seasonal cycles are actually sort of fairly firm here. So just got to be careful not to be too underweight here. I'm sort of really trying to build some positions here. But yeah, I think, I think what will happen is that, Chris, it'll either hit this line and sort of, congest along it, or it might actually pop out of it first. It looks like it's got the feel like it's going to pop out and then maybe come back, retest the line and then go again, something like that. So, the market's got a little bit of strength here to me. So I think more likely it's going to sort of pop out, then maybe sort of congest along the, and then go later on. So I think the signs are good.
Okay, well that's good on the S&P. If we bring it back to the Australian index, the indices, you did mention the commodities. Obviously, we're heavily exposed to commodities. That's a large driver. You can see this huge rally here. You're talking about BHP and Rio Tinto having strong rallies up near recent highs.
Yeah.
So how do you see that playing out for Australia? You're talking about inflation coming off, risk for commodities, but the US market's kind of making a higher low or some sort of patchy movement there and then getting on. Is that a possibility for the Aussie to kind of play that same race?
Can be a false trap here to think that our index is going to follow the US market, and the US market's obviously, had a bigger decline, much bigger decline, particularly the NASDAQ and stuff. There's obviously a lot more growth, a lot more tech in there. We've got less growth in our markets here, so like the FTSE there, we've held up pretty well. We're not too far away from the high. The FTSE's gone to new highs here, which is amazing. Considering, how dire everyone talks about Europe is. But yeah, I don't know. Look, I think our market's going to be a bit messed here. I just think it's going to be just got to look at the sectors here. I think, to me, the commodities is tricky, just because if we look at our normal cycles, that points to sort of commodities should cool off here. If inflation has peaked, then commodities should peak as well here. They should be sort of starting to cool off here. Already seen that a little bit in oil. The only exception to that is sort of gold, and I know everyone thinks gold is a hedge, Chris, but historically, if you actually look at gold, it's got a very similar symmetry to the general stock market.
So the beta is a lot higher than what most of us expect.
Well, everyone thinks you're going to have gold in the portfolio as a hedge, but really the gold actually often mimics the share market. Did you sort of notice when gold actually bottomed here recently?
I remember that you were looking for it. We were doing that on the 30-30 list a lot, running through, seeing some triggers, waiting for it. Yeah. When did it trigger? Was it? So
the gold had a low on the 28th of September, came back basically 21st of October, which is obviously one of our key sort of turning dates, but pretty much, it's October lows here. So it's it's really almost sort of mimicked the share market, the way gold's sort of come off here. So don't be mistaken that gold's a hedge here. I always sort of I struggle to understand that gold is a hedge. And I've sort of found historically that I've usually liked gold when the market's found a low as well, but I've often found other things I like more than gold. So that's why I've never really traded it too much, and then it can be negative when everything else is sort of negative as well. So yeah, I mean, I get the US dollar. That's probably that's the only sort of slight difference there. When the US dollar sort of does have a downward move there, that's obviously when that's impacted sort of gold being the US dollar being on a tear. But I say there's just a high correlation with gold to the overall market I've found historically. So, but yeah, the US dollar chart's pretty interesting because we've sort of had our 3 ascending trend lines there, Chris. We've broken that, the third line there, and then we've had a pretty dramatic decline since then. So back from 115 back to 102, so pretty decent drop here. Come back under the old high there, which I think is probably a bit of a support zone, but that's okay. I mean, just sort of, oftentimes they can have a sort of shoot here. I think this might just be the first leg of a 3-leg down here. So, normally we get a first leg, and yeah, exactly. So some sort of B leg. So look, might go slightly lower here, right? I'd expect a little bit of a bounce here soon, and another leg down here. So, so probably just, I think we've fulfilled a lot of downside targets here. We've had a fairly decent sized move here. So probably, probably at risk of having some sort of bounce here. But on that Aussie market there, I just think it's a bit mixed there. I'm a bit neutral, the Aussie market. I'm concerned that we've got such a heavy weighting in commodities, and the cycle for commodities is, will be a little bit concerned here. So I know BHP's on a low PE and a high yield and stuff there, but those resource stocks, they always are at the top of the cycles. So, when they look really good, fundamentally, that's usually the time to be careful, to be wary of them.
Well, that's a good point. You're looking at commodities, you're looking to understand how that index, the dollar index, is moving. That connects in with commodities somewhat, like you mentioned with gold. You've talked about trading leading shares, the ones we'll look at a bit in a second. But before we do that, we probably want to look at the Dow. You mentioned that the FTSE had been holding up remarkably well, hitting new highs despite all of what's happening in Europe and post-Brexit and all the issues politically they have. The Dow Jones is just looking quite phenomenal. It rallied really strongly off those October lows that you talked about. You traded that. And what you've mapped out here seems like this possibly has the greatest potential. Would that be from the indices?
Yeah, that's just sort of trying to, do a little best fit there. I still think there'll be another little congestion back into Feb, March, even though we've sort of shown, I mean, it's really only a really, really small correction there so far off that sort of December there. Our next sort of timing there is sort of Feb, March, but the 60-year cycle was pretty mild. It had a bit of more of a sidewaysy sort of congestion there. So we might just sort of settle down here and go sideways there, and maybe have a little dip into March there. But then I think, then from March there, I think if we keep getting sort of data that's showing inflation cooling, then I think that can definitely sort of propel the market there. that might be when the Feds comes out and say, okay, we've had three months here of data. Potentially we might, if we get another 2 or 3 months, but maybe we'll start to ease rates or something, and that might just be enough to tick the market off, eventually. So, but yeah, I think we'll eventually go back up, maybe retest the high, go maybe just underneath it, have a bit of a pause into August there. I think our sort of May, June was sort of our 60 years highs. I think come back into August and then kick on through there. As I say, though, statistically we've hit, that 21%, Chris, is the average rally for the midterm year for the last 2 months. That is, I know it looks pretty big on the chart there, but if we look at our 4-year cycle, look at the average midterm year rally for the Dow Jones, that hit it on the dot. So that is just an average move every 4 years. And you probably know what's our move into December the following year. What's our average? I think I've said it a few times now. I reckon you know it by heart.
From the October lows, those 14 odd months,
Yep.
49%.
49%, yeah. So it's around between 48 and 49% is the move by the end of the. So after the midterm year, I think it's within 13, 14 months of that midterm year, we see an average move is around 48, 49%. So pretty decent move here. So no one's saying that, no one's forecasting that. But
you're kind of happy about that. You're happy.
The markets, yeah, exactly. That means there's a chance here. If everyone's forecasting it, it never happens. So, yeah, and as I said, we was shown here in the in those 40s and 70s that just having, even though those markets went sideways and inflation persisted, even in those negative periods, when they had inflation cool off for a few months, that was enough to have the markets to have really big moves. So even with inflation persisting for long periods of time, the market can still have those really, really strong rallies. So, yeah, so it's right to be optimistic here. A lot of people don't really study the past there, don't study history where they really should here, because pretty much everything we've done here so far the last year has mimicked history almost identically.
And yeah, you definitely did nail 2022 with the highs and lows, putting those cycles over each other. Now, that's a good roadmap to have as we sit here in January for the year ahead. They're good sort of markers to work towards. Obviously, you'll finesse that as more market data comes through. But where we stand today, you are looking, you're talking about not being too heavily invested or underinvested, too heavily weighted into cash. You've got some trading shares for us this week. You're starting off with, well, you've got a fair few big names. We've got Medibank. They had that data hack. They had a terrible drop. It was something like 1.74 billion market cap just dropped out of these 2 days. This big movement here of that breach and then holding them to a ransom. What does it look like now for you?
Yeah, I think the stock sort of dropped, 20% on, obviously sort of something of consequence, but something which I doubt will change the fundamentals of the company, short or longer term. So might tighten up their internet security. Probably the safest place to put your data now, because they've probably updated everything. But yeah, look, it's come back here. It's come back to a bit of a support zone there. So sort of just show that sort of red box there is a bit of a zone there where the stocks bounced off before. But I think we've sort of come back now to sort of great valuations. We've had a nice little bounce. We saw some pretty strong volume through that whole period, Chris, as well. And then we've sort of pulled back here, and the volume sort of dried up here, which is what we want to see on a counter trend. And yeah, so this looks quite good here. So it's a bit of a safe play there. I don't think you're going to sort of, it's not exactly a high beta stock here, so it's not going to give you a 1.5 or 2 times market move here, but I think this is going to move nicely here. It's a pretty safe place to start here. So I do like that there. I think that looks quite good. Plenty of other stocks sort of a few stocks have already sort of taken off here, but still a few sort of at some pretty good levels here for entry wise.
Well, the ASX is another one that you've got in this week's report. They've failed with their chest replacement using blockchain technology. They wrote off a huge amount of investment, with most people going back to work, a lot less day traders, so a lot less trading activity and trading volumes going through, and the share price kind of tells those stories, that massive drop there. You've got in here, it's coming back to that old March 2021 low. So is this what's catching your attention, this possible
Yeah,
support?
yeah, came back and made a false break here. So many false breaks here, Chris. I've been thanks to you, sort of giving me a little software to use there. I've been sort of updating my library of sort of false breaks here recently, and I must have put 10 to 12 stocks in here just last week alone. And yeah, there's still plenty more this week. And yeah, so we're just seeing false breaks, which is something we sort of see in more of a range bound type of market as well. But yeah, come back to retested the low, made a false break here. More importantly, they're seeing some decent volume at that low. Had a reasonable bounce there, but we've sort of come back here. Probably the most interesting thing is here, we've sort of rallied for say 4 weeks, and now we're sort of 7, or this will be the 8th week down here. So we rally for 4, pull back for 8. We don't take out the low in twice as much time. It means it's sort of struggling to go down. The volume's sort of drying up as well here. That usually means it sort of goes high here. So I do think this one looks quite good here. And so like a lot of the industrial value sort of stuff is stuff that's sort of moving here. So I think this looks pretty good here. Yeah, I'm looking to sort of add some more of this in here.
Nice. If we look at one of the bigger names on the ASX, it's a well-known one, Macquarie Group, MQG, sometimes known as the vampire kangaroo. A different kettle of fish from Commonwealth Bank. So Commonwealth Bank, you've noted in the last couple of weeks or so, it has come back and retested its highs. Macquarie's a fair way off it, obviously a different structure in how the bank runs and operates. What's catching your eye on Macquarie?
Yeah, so a little bit more growth oriented, obviously Macquarie there. I think there's a few question marks here on the commodities returns that they've had in the last few years, whether they will continue. So the price has sort of come back a bit more. Just notice that probably the most important thing here is that low there in October. Apart from sort of coming back in the right timing here, it's come back and just sat on top of the old 2020 high, which is you think about trends, strong trends, they just sort of build on top of the old high. So you go to a new high, pull back, you break through, you come back and retest, and you sit on that high, and then that's just a normal building process there. So that's constructive to be actually sitting on top of that high, and to have built upon there. And we've seen some decent volume off that sort of low, and then it's edged back here, and the volume sort of dried up again. So and now sort of starting to look like a first sort of higher low off that October low as well. So that looks pretty constructive there. And we sort of saw good volume in the last couple of weeks as well. So really you're just trying to look for any weakness here, any little congestion back into the trend here will hopefully give us a little slightly better entry point. But yeah, it looks pretty constructive to me. So yeah, you just probably just think probably not trying to rush into stuff here, not trying to pay up here at the moment. Just I think the way to go is just to sort of incrementally sort of try and add our portfolios there. You can all kind of rush in here after the market sort of rallied, 7 to 9 days straight up here, and then you're going to move back here. The thing about this market now, Chris, is that if you think about a bear market, we're just going down, and then when we had our rallies, they're really short and sharp, sort of those bear market rallies, So the opposite happens in a bull market. We actually go up, nice and steady and sort of, slowly. And then when we cool off, 2 or 3 days in a bit of a sharp manner. So it'll just go up constantly, like pumping a tire up, and then, you'll basically, and then you go again, and just be, so you just got to wait for those little bit of a, little backdraft. And we might only get 2 or 3 decent down days, but you just got to jump on those when they come in. So, let's say the market's sort of looking pretty bullish here. It'll draw people in. Unfortunately, they'll be buying it sort of into strength, and then we'll get a sharp turn down for a couple of days, and that'll shake some of the weak hands out, thinking we're back in a bear trend again. But I think the market's changed here. I think there's a bit of a change in character, yeah, that's the shift which we should start to see now.
Well, that shift, you've talked about it for many years now, coming out of the lows, looking for the market leaders. So I see a bit of a theme in this report here. But more excitingly, we're back to, for the next chart, is Sonic Healthcare. But the exciting part is that it's a false break, your old favourite that you trade exceptionally well. You've got FB marked on the chart. So tell us how this false break's catching your eye.
Yeah, big false break there. Also, we do have, we've come back 2/3 of the range. So, Gann looked at sort of, quarters and thirds of ranges as being important. And we can see on the way up that the third of the range was sort of an important high. And yeah, so we've sort of come back to that 2/3 of the range on the downside here. Used up a lot of time to get back there. False break here, and it's just sort of starting to build here. So, I think this looks pretty constructive. Volume's a little light at the low there, but it's funny, I did look at Sonic here, and it does have a habit of doing this sometimes, being a bit lighter at some of the lows, and then usually the volume will sort of come in after it gets going rather than at the low exactly. So I think this looks pretty constructive. Good sort of sector here. I really think healthcare is going to be one of those sectors which has a great year in 2023 as things sort of normalise.
Well, another one to look through the report is Reece, REH. Now, this has had dramatic falls coming from almost that $30 level. So 28.48 you've got here at the high and drifting all the way back, not drifting, actually plummeting, $13. The volatility seems to reside. Rally.
Yes,
Yeah. So what's this chart pointing out to you?
So it's come back to the 2018, which is an old high, and it is also around about 3/4 of the range as well. So it's about a 75% on that weekly range as well. So that's our sort of, again, another Gann range. So as much as I show a lot of the Fibonacci ranges on here, I do watch for the Gann ranges as well. Some stocks like the Gann ranges, and some of them like the Fibs. But yeah, this looks quite good here. It's had a nice bounce off there, sort of constructive off the last low. But since then, it's just sort of gone on more of a sideways move there. I just noticed the last little pullback there was on pretty light volume. Again, made a little false break and then gone power, which is sort of, oftentimes these false breaks are, they can reverse pretty quickly. So looks pretty constructive here. So do like this as well. Probably want to see it break through that first sort of lower high there, Chris, too. So which is, I think, around that $16 level there. So, if we break above that, sometimes we sort of get little triggers there. So false breaks our first little trigger. Our second probably,
break that B wave.
Confirmation would, breaking that little high there would be confirmation of a bit more strength as well. So so looks pretty constructive here so far. No one really, I think, everyone wants to sort of stay away from property as well here. People want to stay away from a lot of sectors there. I think it's, it's bizarre here. I mean, everyone's talking about commodities. That's the place you got to be. I actually think that's the place that you shouldn't. That's the place that I think has got the most amount of danger here. If I was a hedge fund manager, I'd be going long industrial, sort of high quality industrial sort of value shares. I'd be starting to sort of build some growth into that. And I'd be starting to short a few little resource and commodities, ones that are sort of flying high here, and starting to sort of turn down, making a few lower highs and then breaking down here. That's the way I'd be looking at it here. So, that looks pretty constructive. I think the next one there, Premier Investments, is probably just a little bit of a little difference for me, probably from a couple of years ago. Probably wouldn't be buying sort of stocks that are going to new highs, whereas we've been learning the last couple of years, Chris, that when you get to the end of sort of bear markets, we should be trying to sort of look for the strongest stocks. They're the ones that sort of outperform and perform the best, sort of moving forward. And we've shown it with a few of those sort of biotechs there. Things like Clinuvel and Polynovo, PME is just that's a sort of sector which has been pretty robust there. But a couple of the stocks here which look pretty good is in like Premier Investments there has had a nice bounce. Interesting here really that the October low for the market, this was a higher low for this stock. So it was already showing relative strength at the low. And it's been sort of, look at the last sort of 2 months there, it's really just congested under the last high there. So hardly had a correction at all while the market's having a bit of a breather, stayed nice and tight, and then now starting to break through here. So, this just looks pretty firm here. So, nothing negative about this at all. Price action looks very positive.
That's what the history books tell us new leaders can look like, right?
That's exactly right. So yeah, so I mean, look, it is obviously quality company, but yeah, you're right. History books, everything. We learn about relative strength and charts and cycles. This is just doing all the right things.
Well, that's definitely one to keep on the watch list. There's one more that you've got in this week's report. So we move over to Qube Holdings. The volume seems to be pretty important on this one. So what's catching here on this range, this movement? How do you read the touches and volume?
Yeah, so similar to Premier Investments there, this has definitely showed some relative strength there. This pullback in the stock here has been very mild. So it's like what we call a corrective decline. So it's overlapping in nature. It's not impulsive. It's not basically leaving spacing. It's basically overlapping. So it's actually sort of struggling really to go lower. Each time it's sort of, it pulls back. It only pulls back sort of marginally lower, and then it bounces right back up in the trend again, and then pulls back slightly lower, pulls back in the trend again, goes slightly lower, pulls back in the trend again. And looks like now we're sort of starting to turn up out of that sort of congestion and showing relative strength here again. There's 3 or 4 weeks on its side here, didn't go down too much, and now within a week we're at a new high here. So again, showing relative strength there. History says these are the stocks that we should be following here. Follow the strength, follow the weight of money. These stocks will lead.
They're definitely ones on that watch list. If we circle back to the start of the conversation, you were talking about commodities, cycles, bonds, equities, and commodities. If we move into your top tweets for this week, we've got some good charts in here. So if we maybe jump on to the one to the right to start off with, you got blue, light blue, and what sort of gold for commodities. What's that telling us?
That's right. So we've seen bonds have had a pretty deep bear market now. Even equities as well have had a reasonable sort of move here, but the commodities is really, it's late stage here. So so either inflation is going to hang around and commodities are going to hang around, or if inflation continues to ease here, then commodities should come back here. That's what our textbooks sort of tell us here. That's what our cycles tell us as well. And so far we've followed the path for the other 2 asset classes. They've had their corrections. So this is my concern here for commodities in general here. I think really gold is probably the only exception there for me. It can do its own thing at times, and it kind of more aligned to equities curve rather than the commodities curve. But that should be a concern there for commodities there. This is the point where all the analysts are saying got to be long commodities because they've obviously had a great period and commodity prices are elevated. But if history sort of shows us an example here, if commodities sort of cool here, then those commodities should start to cool here. And that oil, which is the leader of commodities, it should lead on the way down as well. And that has done. That's probably the one that has cooled off the most here. So just got to be careful there because the commodity curve is telling us to be very careful there right now.
Well, that's a word of caution, definitely. And the other one that you've picked up this week, you're talking about large cycles and an indicator that you've. So what is this indicator and what's it telling us?
Yes, I follow a few professional traders in the States there, just online there. Sort of, so a lot of the what I consider the most successful traders in the States that I follow. A lot of them are talking about this on a Friday night, and this is the Walter Deemer, who's a bit of I guess a bit of an icon, technical analysis. Been around a long time. He's still pretty active tweeter actually, Walter Deemer. But he was talking about this basically like it's advanced a sort of decline line, and it's the amount of sort of stocks here. So we just had 1,854 net advances today, which is quite a big trigger, what they call a breakaway momentum signal. And so what Walter was sort of saying, every time in the past there, and then I saw people were actually I think Roy Maddox was actually posting the numbers as well. So actually had all the other numbers there. So I think the average rally after this breakaway momentum signal was 15.1% over the next 9 months after the signal. So that definitely aligns with our cycles, and as a good I guess potentially a good omen anyway, for the bulls here to get that sort of trigger. So yeah, pretty healthy sort of signal as well, getting that sort of market, basically you're getting, lots of stocks here all trigger at the same time, which is, if you think about it, one of the reasons why I was able to identify the top of the market and then the market breaking down was that we saw the fewer and fewer stocks were doing the lifting at the end, which is what our textbooks tell us historically. And when you get to the end of the bull phase, the heavy lifting is done by the very few at the top, and then they finally crumble. So that's exactly what's happened. And once you get the breakaway move here, you get widespread momentum. You're basically looking for not just a few stocks to do the lifting, but for the broader market to get involved here. And that's what this trigger is here. And that's a good sign technically.
So the market breadth gets really skinny at the top. We did see that. We saw the NASDAQ being covered by sort of the FANG stocks and a very few. And you were also commenting at the time that so many were hitting new lows while the index was up there. And this is the opposite happening. We're seeing that breakaway momentum signal. We're seeing a great amount of participation. They might be small caps and not really moving the index so much, but it's showing there's a huge amount of breadth in the market recovery. Is that one way to look at it?
100% bang on the money, Chris. Yep.
Okay. Well, I've been reading some textbooks. So it's paying off.
Yeah. No, they're good signs. So, I mean, there's sort of, So the beautiful aspect here is everyone will be pretty cautious, underweight. So that's going to fuel the rally here. We're starting to see change of character. We're starting to see, some of the growth stocks sort of move here. So the biggest concern for me is commodities. I just won't be, to me, I'm finding it too hard. So I could be wrong. I could be wrong about commodities. Maybe commodities will hang around. Maybe there was a big moves there. Maybe these coal and lithium and oil and all these sort of stocks will continue to keep going up. History says that's not the case, but I could be wrong. Inflation does indicate those stocks can do well in high inflationary periods, but with inflation starting to cool, that should put that in question. So, but that's the only really thing I'm doubtful at the moment is what they're going to do. Me personally, I'm looking at the short side for something like a BHP, which has sort of made a big move here. Everyone's in love with that stock. I think it's getting pretty vertical here. I've been building a basket of long stocks here. I'll put a little bit of growth in there, and I might hedge it with a little bit of a short BHP in there, just to round out my little portfolio. So that's the way I look at it here at the moment. Won't go too aggressive there on the short side. We're coming out of a pretty deep sort of October low sort of building phase here. So it's probably pretty important not to be too short here, I think, at all. So more important to sort of be building good stocks there and just keep running as sort of stops underneath it. I think giving yourself a little bit of room here initially, sort of, maybe start small, give yourself a little bit of room on the stops. As they start to sort of build and move higher, you can move your sort of stops to sort of break even. And then we can sort of, maybe start to add a little bit of beta into our portfolio over time here. But I think this is a bit of a slow process there. I wouldn't do it too quickly, just patiently sort of wait in the market here and just sort of keep building here. But really like the signs here for 2023 already. Good signs already.
Nice. Well, that's a great way to be starting the year with good positive signs for a portfolio. Good clear way ahead. And we'll wrap it there and say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
Well, if you like Gary's reports in there's a whole playlist of them on the right-hand side for his previous reports. You can go back and see how he's called throughout 2022, the highs and lows, and he caught them within a few points in a few days. So that's good viewing back there. He's also mentioned a fair few different types of strategies. False breaks or springs, volatility contraction patterns are a common one, and other patterns and details that he's gone into trading strategies, behaviours, and understanding markets. There's a whole playlist of that on the right-hand side. And he is also relatively active on Twitter. He's shared his favourite tweets for the week. But on the left-hand side, you can see Gary's handle if you want to follow him there.